Credit is not a modern invention. Although new credit forms have been developed in the modern world, credit was in general use in ancient and medieval times. Credit was around long before industry, banking, and even primitive forms of money. Loans at interest probably started when a Neolithic farmer made a loan of seed to a cousin and expected more back at harvest time. Irrespective of when credit started, the recorded history of several great civilizations started with credit rules and regulations. Around the year 2450 BCE, the Sumerian city of Lagash and its neighboring city, Umma, were at war because of a border dispute. The city of Lagash was victorious. Details of the war were recorded on the foundation stone of a temple in Lagash. According to a passage, inscribed on the foundation stone, Lagash had lent a large amount of barley, at interest of 33.33%, to Umma, but Umma did not repay the loan. The amount due by Umma to Lagash, as recorded by a scribe, shows that compound interest was charged. Not only did this passage describe the first border war ever recorded, but it also confirmed that compound interest was charged as far back as 2400 BCE. The Babylonians specifically referred to interest on interest, Sabat Sibtum in Akkadian, which means interest on interest, around 2000 BCE. They even solved mathematical problems on it. The earliest formal written legal code dates back to around 1800 BC. It was introduced by Hammurabi, a king of the first dynasty of ancient Babylonia. Some of the main provisions of this code regulated the relationship between a debtor and a creditor. The maximum rate of interest was set at 33.33% per annum for loans of grain, which was repayable in kind, and at 20% per annum for loans of silver by weight. It was also a requirement that all loans had to be recorded in a written contract and witnessed before officials. If a creditor was caught trying to recover a higher rate than the legal interest rate, the principal debt was cancelled. Land and movables could be pledged for debt. The debtor, his wife, concubine, children, or slaves could be offered as security as well, but personal slavery for debt was limited to 3 years. The legal history of classical Greece began around 600 BC with the laws of Solon. There was an economic crisis in Athens caused mainly by excessive debt and personal slavery for debt. In contrast to the Code of Hammurabi, the laws of Solon did away with all limits on the rate of interest. Although hypothecation was allowed, personal slavery for debt was forbidden. The Roman Empire also introduced a body of laws, referred to as the 12 Tables, around 450 BC to regulate credit. This, too, was brought about by an economic crisis caused by excessive debt. Interest on loans was limited to a maximum of 8.33% per annum. The penalty, if a creditor charged higher rates, was 4 times the amount in damages. Although personal slavery for debt was allowed, the physical well-being of the slave was protected. The approach to interest on loans changed dramatically during the Middle Ages, which started with the fall of the Roman Empire in the late 5th century, and lasted until the Renaissance in the 1500s. The ability to charge interest or not was the subject of many theological and legal discussions during this whole time. A good example of the approach during this time was a series of laws around 800 AD known as the Capitularies of Charlemagne. These laws, when dealing with credit, made it illegal to charge interest on loans. Francesco Balducci Pegolotti worked for the Florentine Bardi family, who owned a banking and trading company. It was one of the major medieval super companies of the 14th century. His book, The Practice of Marketing, Pratica della Mercatura, published around 1340 CE, not only provided details of trade and travel in his day, but it also contained a table of compound interest. During the Renaissance, it became acceptable again to charge interest. The debate amongst economists, financiers, and politicians now turned to the question of whether interest rates should be controlled by the state or not. England, for example, followed the Solon approach and did not set fixed legal limits on the rate of interest. The United States, on the other hand, did set fixed maximum rates of interest and, in this respect, continued the legal traditions of Hammurabi and Rome. In this presentation, we want to distinguish between a bank's interest income and non-interest income. Banks convert their liabilities into assets. Liabilities, consisting of capital, deposits, and borrowing, are sources of funding to finance the bank's operations. This is the consolidated balance sheet of all the banks doing business in South Africa as of December 2021. Shareholders provide the bank's share capital. A commercial bank accepts deposits from the general public and borrows money from other banks, the South African Reserve Bank, and the foreign sector. Together, deposits and borrowing can be classified as funds obtained from creditors. This confirms the accounting equation of assets equals owner's equity plus creditor's liabilities. There are just two sources of funding to finance the investment in assets required by a business, and in this case a bank, namely own funds and borrowed funds. The return on equity is important for shareholders, since this indicates the return that these equity owners earn on their investment in the bank. Investors obviously want more out than what they invested in the first place, to reward them not only for the time value of money, but also for the risk that they undertake by investing in the bank. The return for normal shareholders often differs from the return to preferred shareholders because of their different risk profiles. In the case of a bank, the main source of funding comes from deposits, almost 5 trillion rand. A bank offers a competitive market rate in order to attract longer-term deposits. A bank, however, normally does not pay interest on deposits in short-term transactional accounts or demand deposits. The interest paid on deposits could, therefore, vary between 0% and whatever a competitive market rate may be at the time. Banks also borrow money in the wholesale market. They borrow money from the South African Reserve Bank, other banks and financial institutions, and in foreign markets. The banking industry owed almost 740 billion rand to these creditors at the end of December 2021. Many people think that the South African banks borrow mainly from the South African Reserve Bank. This is obviously not the case. The South African banks do not just borrow from the South African Reserve Bank. The different classes of shareholders and creditors obviously require a return on their investment. The rates of return differ for each source of funding because they have different time horizons and risk profiles. All sources of funding come at a cost, and the cost associated with each type of funding varies. It is important to be able to determine the average cost of funding. A bank's treasury department continuously calculates the actual cost of funding for the bank, based on the various sources of funding and the differences in pricing. The weighted average cost of capital is the rate that a company pays, on average, to its shareholders and creditors. It is the average, after-tax cost of a company's various capital sources, including ordinary shares, preferred stock, bonds, and any other long-term debt. In other words, the weighted average cost of capital is the average rate a company expects to pay to finance its assets. The formula used to calculate the weighted average cost of capital shows, in a single figure, how much interest, on average, a company pays for its different sources of funds. The formula may look difficult at first, but an example will quickly clarify the approach. A company has a capital structure that consists of 35% debt, 60% common stock, and 5% preferred stock. The interest paid on the debt is 6.0%. The interest paid to the preferred stock is 7.5% and the return to the common equity is 10%. The company's tax rate is 25%. The weighted average cost of capital of the company can now be calculated. On average, the three different sources of funding costs this company's 7.95%. It comes as a surprise to many people when they note the relatively small amount that banks borrow from the South African Reserve Bank. Of the 740 billion rand borrowed in the wholesale market, only 46 billion rand, or 6%, was due to the Reserve Bank in December 2021. The borrowing banks must provide security against any loans obtained from the South African Reserve Bank. The security referred to here is often in the form of government bonds. Banks repay the loans received from the Reserve Bank by buying these bonds back. In other words, banks repurchase the security given to the Reserve Bank against the loans obtained. The price paid to repurchase the security includes the amount borrowed, plus the interest due on the loan. The amount of interest paid is known as the repurchase, or repo, rate. The current repo rate, at the time of this presentation, is 4.75%, which means the banking sector borrows money at a rate of 4.75% from the Reserve Bank. When the Reserve Bank considers how much money to make available to the banking system, it considers the prevailing inflation rate. If inflation is high, or if there is upwards pressure on the general price level, then the Reserve Bank reduces the amount available for lending to the banking sector, as part of a contractionary monetary policy. If the Reserve Bank feels that inflation is under control, then the amount available to the banking sector can be increased. In addition to the money supply, the Reserve Bank also uses the repo rate as a monetary policy tool to manage inflation. 6 macroeconomic objectives can be identified, namely: 1. Economic growth, calculated as gross domestic product calculated as the sum of consumption, investment, government spending, and net exports. 2. Job creation, which would be a natural consequence of economic growth. 3. With a growing economy and increased production, prices will remain stable and inflation will be under control. 4. Stable interest rates will follow as a consequence of no or low inflation. Interest rates must be high enough to attract savings, but not too high since that will discourage investment. 5. A balance of payments, meaning that a country can pay for its imports from income earned through exports. 6. With economic growth, and all the positive effects listed above, the size of the domestic economic activity increases, allowing for a more fair distribution of wealth. Fiscal and monetary policy guide the process. Fiscal policy involves government spending and taxation which affect the real economy. And expansionary fiscal policy involves increased government spending and/or reduced taxation. Reduced government spending and/or increased taxation are tools of a contractionary fiscal policy. The main objective of monetary policy is to keep inflation under control. The Reserve Bank, as the monetary policy in South Africa, has a stated objective to keep inflation between 3% and 6%. The main tools employed to achieve this are the interest rate and the money supply. An expansionary monetary policy involves reducing the interest rate, and a contractionary monetary policy will increase the interest rate. So why is the repo rate so significant? Although banks obtain only about 6% of their borrowing requirements from the Reserve Bank, the repo rate serves as a signal to all the participants in the economy. It shows the monetary policy approach of the Reserve Bank with regard to inflation, and the condition of the underlying economy as a whole. As such, the repo rate influences all other borrowing and lending rates, and the associated saving and investment decisions. It is the benchmark rate against which all other interest rates are set. The Reserve Bank uses the repo rate to influence interest rates throughout the economy. Having considered the cost of funding, represented by a bank's liabilities, we now move over to the asset side of the bank's balance sheet. A bank uses its liabilities, in the form of capital, deposits, and borrowed amounts, to fund the bank's assets consisting of reserves, loans, and investments. As stated earlier, shareholders and creditors require a return on their money, and this constitutes a cost for the bank to acquire these funds. Other than keeping a relatively small amount as a reserve, the bank, in turn, lends these amounts out to debtors in the form of secured or unsecured loans. And the bank also invests some of the money in financial assets, notably equities and bonds, to generate income for the bank. Banks must keep reserves in the form of cash balances at the Reserve Bank. A bank can obviously not lend out every cent it receives in funding, since it requires a degree of liquidity to repay bank deposits to clients, and borrowed amounts to creditors, when these become due. Banks are, in terms of banking legislation, only required to keep a minimum of 2.5% in reserve. According to the December 2021 combined balance sheet, the South African banks held 2.86% of total assets as reserves at the Reserve Bank. A distinction is made between a bank's banking book and its trading book. We will first consider a bank's banking book, consisting of loans. Banks traditionally accept deposits and make loans. This activity takes place in the bank's banking book. In order to make a profit, a bank must charge a higher rate of interest on loans granted than its cost of funding. The reference rate used for lending purposes is the prime rate. The prime rate represents the interest rate that a bank charges on loans with low risk. It is, in other words, the best lending rate available to low-risk clients. The current prime rate, at the time of this presentation, is 8.25%. The banks set their prime lending rate with reference to the repo rate, which, as we have already seen, serves as the benchmark rate in the economy. It is fair to make the assumption that the average weighted cost of funding, for the banking industry, is close to the repo rate. Based on this assumption, we can now calculate the bank's gross profit margin on loans as the difference between the prime rate charged by banks and the repo rate paid by banks. The difference between the prime rate, at 8.25%, and the repo rate, at 4.75%, is 3.5%, which generally represents the interest markup that banks earn on low-risk loans. So, the banking book shows a bank's exposure in respect of loans granted. The fact that banks take deposits and make loans exposes them to interest rate risk. Interest rate risk is the risk that a bank's income from loans granted could be adversely affected by interest rate movements. Consider the following example that will illustrate this. A bank accepts a fixed deposit for a 2-year investment period at a fixed rate, valid for the duration of the deposit, of 8%. The bank uses the funds to grant a 5-year term loan at a fixed rate of 12%. The bank pays 8% and receives 12%, leaving a margin of 4%. This is all good and well. After 2 years, the bank must repay the deposit. The loan, however, has another 3 years to go. Assume that interest rates did, during the 2 years, increase and that the bank can now, after the initial 2-year period, only attract deposits if it is willing to pay 14%. The problem is obvious. The bank pays 14% on the deposit but only receives 12% on the loan. One solution is for the bank to only grant loans with flexible interest rates, linked to the prime rate, to allow for the interest rate applicable to the term loan to be adjusted in line with the prevailing interest rates. The interest earned from the bank's assets, minus the interest paid in respect of the bank's liabilities, reflects the bank's net interest income. The net interest income for all the South African banks combined for the 12 months to the end of December 2021 amounted to 188.07 billion rand. The bank's net interest margin can now be calculated as the bank's net interest income is a percentage of the bank's interest-earning assets. The net income margin for the South African banking sector was 3.86% at the end of December 2021. Interest rates also come into play when dealing with credit risk. Credit risk is the possibility that a lender may suffer a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. Lending is a fundamental part of banking business, and it is expected that banks will have risk models that can be used to assess and manage credit risk. 4 variables normally determine credit risk. 1. The probability that the borrower will default on a loan. An assessment and evaluation of the borrower's financial statements, the industry within which the borrower operates or is employed, as well as the length of the relationship with the borrower concerned, could provide insight in this regard. 2. The amount due in the event of the debtor actually defaulting on a loan, also known as the exposure at default. The nature of the product is important in this assessment. An unsecured overdraft is, for example, riskier than a term loan, where the debtor is required to repay the capital and interest over the agreed time period. Consider 2 loans. An overdraft of 1 million rand and a term loan for 1 million rand. Should a debtor with an overdraft default, the outstanding amount due to the bank will in all probability be the full amount of the overdraft, since the debtor is allowed to use any available funds up to the amount of the overdraft granted. In the case of a term loan, the amount due should the debtor default will be less since the debtor would have repaid a portion of the capital and interest, without the ability to access the amounts already repaid. 3. The mere fact that an amount is due when a debtor defaults, does not necessarily mean that the bank will have that full amount as a write-off. The actual loss, given the default, will depend on any available security at the time that can be used to reduce or even settle the outstanding amount. 4. The duration of the loan will also play a role in determining the risk associated with a loan. By using risk models and risk assessment, bankers can calculate the statistical possibility of a loss. This risk can then be incorporated into the pricing of the loan. A low-risk client, as said before, may qualify for a loan that is granted at the prime rate. Banks do, however, in order to compensate for higher risks, require a higher interest rate, normally in the form of prime plus some value. This is in line with the principle that higher risk requires a higher return. The trading book reflects a bank's investment position. A bank uses some of its funds to acquire financial assets, and mostly so in the form of bonds and equities. By investing in financial assets, a bank is exposed to market risk brought about by changes in interest rates. An increase in interest rates can cause a drop in the price of bonds. A decrease in interest rates, on the other hand, can increase the market value of these financial assets in the bank's trading book. Remember, there is an inverse relationship between interest rates and the price of bonds. If interest rates go up, bond prices go down. The following example will clarify this inverse relationship between interest rates and bond prices. An investor has 100,000 Rand to invest today. The investor notices that the interest rate in the private sector is 12%. In other words, when individuals and businesses lend and borrow in the private sector, they do so at, on average, 12%. The government, aware of the 12% interest rate being charged and paid in the private sector, decides to offer a 3-year government bond at a fixed rate of 10%, paid semi-annually or twice a year. The government offers less interest because its security represents less risk when compared to private sector investments. The investor now has a choice. Invest his 100,000 Rand in the private sector at 12% or buy a government bond with a return of 10% fixed for the duration of the investment. The investor decides to buy the government bond. This investment will repay the investor the following amounts. 100,000 Rand by 10% equals 10,000 Rand per year or 5,000 Rand every 6 months. The investor will accordingly earn the following income streams. 5,000 Rand 6 months from now, another 5,000 Rand in 12 months, then another 5,000 Rand in 18 months, another 5,000 Rand in 24 months, and one more payment of 5,000 Rand in 30 months. At the end of the 3 years, the government will pay the last interest payment of 5,000 Rand in the capital amount of 100,000 Rand. Assume that interest rates increase in 6 months' time. The private sector interest rate increases to 13%, then 14%, and then 15%. The bond investor still gets a 10% fixed rate of return, translating into 5,000 Rand every 6 months. This investor, feeling that he is losing out, decides to sell his government bond in order to release the money so that he can go and invest it in the private sector at the higher rate of 15%. Other investors are not willing to trade places with our bond investor. He does, however, receive an offer of 90,000 Rand for his government bond. Hoping to make up the loss, our investor decides to sell the government bond, with a maturity value of 100,000 Rand, for 90,000 Rand. The bond is therefore sold at a discount. The buyer of this bond parts with 90,000 Rand, and obtains a bond with a face value of 100,000 Rand. The interest rate that the government pays on this bond, however, remains at the fixed rate of 10%, or 5,000 Rand every 6 months, for the remaining time. Although the interest rate that the government pays remains at 10%, you instinctively feel that the new buyer is actually in a better position, and that he is in fact receiving more. The previous investor received 10,000 Rand a year on a 100,000 Rand investment. The new owner still receives 10,000 Rand per year in interest, but based on a purchase price of only 90,000 Rand. To distinguish this from the interest rate reference, we now introduce the concept of yield. The government pays an interest rate of 10%, but the new investor's yield is in fact 11.11%. This is calculated as the interest amount of 10,000 Rand, divided by the 90,000 Rand paid by the new investor. In this sense, the yield represents what the new investor paid compared to what he receives. So, the relationship is clear. If the interest rate increases, then the value of the bond decreases. The yield on the bond for the new owner increases as well, in line with the movement of the interest rate. Now assume that the private sector interest rate drops to 11%. A higher risk investment in the private sector returns only 11%, while our low risk government bond returns 10%. Suddenly investors are keen to buy this government bond from the current owner. Notwithstanding the fact that the new owner only paid 90,000 Rand for the bond, with a maturity value of 100,000 Rand, he now gets an offer of 110,000 Rand for his bond. He decides to sell the bond and he makes a capital profit of 20,000 Rand. The bond is sold at a premium. Remember, he bought the bond for 90,000 Rand and he sells it for 110,000 Rand. The new owner still gets 10,000 Rand interest from the government, but this represents a yield of 9.1%. The calculations above measure the current yield. The formula for the current yield equals the income expected from the investment, divided by the current price of the security. The current yield is an indication of what the investor gets, compared to the current market price that he paid for the bond. To summarize the relationship between bond prices and interest rates, when the interest rate increases, bond prices drop, and the yields go up. When the interest rate drops, bond prices increase, and the yield goes down. The relationship between interest rates and yields is direct, meaning when interest rates go up, then yields go up as well. When interest rates drop, then the yields drop as well. An increase in interest rates also normally impacts negatively on share prices. Consumers buy less when interest rates increase. This causes businesses to sell less, which adversely affects their profitability and earnings. With reduced earnings, businesses pay fewer dividends, and retained earnings also reduce, which in turn affects shareholder wealth. With these negative prospects, existing shareholders tend to sell their shares within a bear market, causing share prices to drop. It is therefore evident that financial assets held by a bank in its trading book are exposed to market risk. A change in the interest rate can affect the market value of these financial securities. For this reason, investors, borrowers, and lenders will want to know what the future holds for interest rates. Are interest rates expected to increase, decrease, or remain stable? This brings us to the term structure of interest rates. The fact that there is a direct relationship between yields on bonds and interest rates can provide insight into expected interest rate movements in the future. All we have to do is plot the yields of selected bonds over a period of time to reveal a pattern of bond yields in a graph, known as a yield curve. The term structure of interest rates has three main shapes. 1. An upward sloping curve where long-term yields are higher than short-term yields. This is considered to be the normal slope of the yield curve, and signals that the economy is in an expansionary mode. 2. A downward sloping curve where short-term yields are higher than long-term yields. This is also known as an inverted yield curve, and signifies that the economy is in, or about to enter, a period of recession. 3. A flat curve where there is very little variation between short and long-term yields. This signals that the market is unsure about the future direction of the economy. Banks use statistical models, like VAR, or value at risk, to assess the losses that could possibly arise in a portfolio, or in the trading book. VAR summarizes the risk of a loss in a portfolio of financial assets, over a defined time period, at a given confidence level, in a single number. Say, for example, the VAR of a portfolio, over a 1-week period, is equal to minus 1.5% with a 95% confidence level. This means that an investor can expect, with a 95% confidence level, to lose less than 1.5% of the value of the portfolio within the week indicated. There is only a 5% chance that an investor could lose more than 1.5% during that week. The banking book could possibly offset losses in the trading book. If interest rates increase, the value of financial assets in the trading book, such as bonds and equities, drop. Higher interest rates, however, increase the amounts received on the loans in the banking book, if these loan rates are linked to the prime rate. Higher interest rates, however, also increase the credit risk, and could result in more loan defaults as well. It is, since interest rates play such an important role in the business of a bank, important to understand the theory behind interest rates, and the significance thereof in the modern economy. What is the relationship between savings and investment? How do households and businesses make savings and investment decisions? The following 4 theories will provide insight into how interest rates influence household and business decisions in this matter. The classical theory of interest is also known as the real theory of interest rate. According to the classical theory, the rate of interest rate is determined by the intersection of demand for, and supply of, investment or capital. According to this theory, interest is the price of investment because firms borrow money for investment purposes, for example, to buy the machinery and equipment required to produce products and services. From the firm's perspective, investment is determined by the prevailing interest rate. A low interest rate encourages high investment, and a high interest rate leads to a reduction in investment. So, investment is inversely related to the interest rate. The firm's demand for investment is fulfilled by household savings. Households save their money to earn interest. High interest leads to high savings, and low interest leads to low savings. Thus, saving is directly, or positively, related to the interest rate. With saving on the supply side, and investment on the demand side, the interest rate is determined at the point where the supply of savings and the demand for investment cross or intersect each other. The interest rate adjusts to keep saving and investment in equilibrium. This interest rate is called the natural rate of interest. When the market rate of interest is higher than this natural rate of interest, savings will be greater than investment. As a result, the interest rate will fall until the equilibrium rate of interest is achieved. When the market rate of interest is lower than the natural rate of interest, the investment demand will be greater than the available savings. As a result, the rate of interest will increase until the equilibrium rate of interest is achieved. It is important to remember that saving, in the classical theory of interest, refers to the supply of capital. In other words, saving in the classical theory does not refer to money, but to those goods and services which, instead of being consumed, are employed for productive purposes, and this is the reason why the classical theory is also referred to as the real theory of interest. According to the classical theory of interest, current income is either consumed or saved. The portion of current income that is not consumed can be saved, and this saving is all that is available for investment purposes. According to the neoclassical theory or loanable funds theory of interest, there are more or additional sources of funding available for investment, and not just savings from current income, to make up what is called the available loanable funds. According to the neoclassical theory, the rate of interest is determined by the available loanable funds. These loanable funds are not just restricted to savings, but also include bank credit and existing wealth that can be converted into funds that can be available for investment. The loanable funds theory of interest rate considers savings, but also the supply of money and the available wealth. The supply of money, M, is vertical because it is a fixed amount that is determined by the monetary authorities. In the loanable funds theory, the amount of saving depends on income and is independent of the prevailing interest rate. Savings are determined by changes in income and not the prevailing interest rate. Saving also occurs at higher levels of income. People do own existing wealth in the form of, for example, financial assets, gold, art, or property. Wealth is interest elastic, meaning that wealth is dependent on, or sensitive to, the interest rate. If the interest rate increases, it brings out more hoarded funds, and a decrease in the interest rate has the opposite effect. Owners of wealth may be willing to convert their wealth into funds available for investment purposes, if the interest rate is high enough. The amount of wealth, available as invested funds, is therefore directly related to the interest rate. The savings line is determined more by income than the interest rate, and is, therefore, steeper or less elastic than the wealth line. The wealth line is determined by the prevailing interest rate and is, therefore, flatter, confirming that it is more elastic, or more sensitive, to the interest rate. The available money supply, savings, and wealth are represented in the line, M plus S plus W, which shows the total loanable funds available for investment purposes. The interest rate is then determined by the point where the total loanable funds intersect the investment demand. According to Keynes' theory of liquidity preference, people have a preference for liquidity. Keynes said that people hold money for three reasons, namely a transactional motive, a precautionary motive, and a speculative motive. People need money to pay for their day-to-day expenses and possible or foreseeable expenses. The transactional and the precautionary motives to hold money is dependent on income. The speculative demand for money, on the other hand, is dependent on the interest rate. People will hold less speculative money if interest rates are high and vice versa. The speculative demand for money is therefore inversely related to the interest rate. At a higher level of interest, people will hold less speculative money in the form of cash, since they would rather invest it to benefit from the higher interest rate. At a lower interest rate, people may be less inclined to part with their cash. Keynes also assumed that the amount of money is fixed and determined by the monetary authority. The short-term rate of interest is then a purely monetary phenomenon to reward the owners of money, and as an incentive to part with this liquidity. The interest rate is the opportunity cost for holding money. People will, if the interest rate rises, hold less of their wealth in the form of cash money. The interest rate is then determined at the point where the demand for money, MD, equals the supply of money, MS. The demand for money has two main components, namely 1. A transactional and precautionary demand, L1, which is determined by, or a function of income, Y. A speculative demand, L2, which is determined by, or a function of, the interest rate. The demand for money, therefore, is MD equals L1Y plus L2R. Equilibrium will occur when the demand for money, MD, equals the money supply, MS. Equilibrium will take place at point E at an interest rate of R1. So, according to Keynes, the speculative demand for money moves inversely with the interest rate. If the interest rate increases, then the demand for holding money for investment purposes reduces. At a higher interest rate, people will hold less money, and will rather invest the money in interest-bearing investments. If the interest rate drops, on the other hand, then people will hold more money in cash since the cost of holding money, or the opportunity cost, is low. Remember, if people hold money, they lose out on the opportunity to invest the money at the prevailing interest rate. The prevailing interest rate is therefore the opportunity cost for holding money in cash. This speculative demand for money, associated with changes in the interest rate, is indicated by the downward sloping curve from point A to point C. Keynes then identified what he called the liquidity trap. This is indicated by the flat line CB. According to Keynes, if the interest rate drops to a certain level or below, the demand curve for money becomes infinitely elastic. This is indicated in this graph, where the interest rate drops to 5.4%. Keynes argued that the interest rate will not drop below this barrier of 5.4%, even if the money supply increases, because any additional money will be kept by people, in the form of cash. People will, at this rate of interest, hold on to any additional cash, and they will not seek any investment opportunities. Keynes' argument was that people will, for example, not invest in bonds if they do not expect the interest rate to drop further, below 5.4% in this case. Remember, there is an inverse relationship between bond prices and the interest rate. If the interest rate will not fall, then bond prices will not increase. If bond prices will not increase, then there is no possibility of making a profit by investing in bonds. People will therefore keep all their money in cash after point C. On the other hand, with interest rates so low, there is every possibility that it may rise in the future above 5.4%. If the rate of interest does increase as expected, then bond prices will fall. Anybody investing in bonds at this point in time will then suffer a loss in the future because bond prices will decline if the interest rate does rise. If people expect bond prices to fall in the future because of a rise in the interest rate, then they will keep their speculative money in cash and only buy bonds when the interest does rise as expected. So, according to Keynes' theory of liquidity preference, the rate of interest will fall if the supply of money increases, but only to a certain point, indicated in this example as 5.4%. An increase in the supply of money will thereafter not cause the rate of interest to fall further. According to Keynes' liquidity preference theory, the interest rate will remain steady at 5.4%. Through the equation, MV equals PY, Irving Fisher linked the real economy and the money side of the economy. In this equation, M represents the quantity of money in existence, and V is the velocity of money, or, in other words, the number of times that this money changes hands during a certain period of time. A smaller quantity of money may be sufficient to finance transactions if the money actually changes hands frequently. If the money does not change hands frequently, then a larger amount of money is required to finance the transactions. The P, in the equation, is the price level, and the Y is the total market value of all goods and services transacted. The amounts spent on purchases, or MV, must equal the amounts of all items sold, PY. If the money supply, M, increases while the velocity, V, and total production, Y, stays the same, then prices, P, must increase to keep the equation in balance. This means that an increase in the money supply, without an increase in production, will result in an increase in the price level or inflation, which, in turn, will put upwards pressure on interest rates. If the amount of money in circulation changes in line with production in the real economy, then prices, inflation, and interest rates will remain stable. If not, then the impact will be felt in the form of inflation and interest rates. Inflation means an increase in prices, or a reduction in the value of money. More money is required to buy the same amount of goods, meaning the demand for money increases. An increase in the demand for something normally means that it becomes more expensive. The price of money is the interest rate. Inflation, accordingly, results in an increase in the interest rate. The interest rate can, therefore, be seen as the transmission mechanism that links the real economy and the money side of the economy. Through the equation MV equals PY, and with interest rates as the transmission mechanism, we have linked the real economy and the monetary side of the economy. We also considered how interest rates, as a monetary policy tool, can be used to keep inflation under control. The statement can now be made that real economic growth is only sustainable during periods of low inflation, and with an interest rate level that is high enough to attract savings, yet not too high that it discourages investment. This presentation so far has only focused on the interest income associated with the lending activities of the banking industry. The net interest income of all the South African banks, over a period of 12 months to the 31st of December 2021, amounted to 188.07 billion rand. Banks do, however, also earn income from non-interest related sources. The bank's non-interest, or fee income, over the 12 months up to the 31st of December 2021, amounted to 133.18 billion rand. Of the total income amounting to 321.25 billion rand earned by the South African banks during this time, 58.54% was earned through interest income, and 41.46% was generated through non-interest or fee income. With the surge of alternative lenders, competition among banks is stronger than ever. But what exactly does that mean for the everyday banker? The traditional banking business model is under pressure, and banks all over the world are working on re-engineering the banking business model of the future. Any organization can lend money and charge interest. Many credit assessment processes have largely been automated. Special skills are, however, required in order to earn fee income, and this is where bankers can differentiate themselves. Focus on becoming a trusted advisor, where clients will pay for your financial advice. Meeting clients once a year to discuss a renewal of their facilities is no longer good enough. In order to take customer service to the next level, a banker needs to operate as a trusted financial advisor, someone who understands where his or her clients are going, and how to help them get there. One of the biggest complaints from business owners is that bankers simply don't understand their business. A good banker must understand his client's business, competitors, and the industry within which they operate. This means acting like a business partner, not just a banker. Technology can be used to create strong relationships by giving bankers information about their customers to help serve them better. Insight into a client's business and financial history will enable a banker to offer custom-designed and personalized solutions to their clients. The value of a healthy banking relationship and a financial guide that adds value can contribute greatly to the success of a business. Instead of a short-term transactional approach, bankers should focus on the long-term benefits that a trusted financial advisor can bring. The banker of the future must, in order to make this happen, have certain skills. Analytical skills to identify trends, patterns, and definitive conclusions from the vast amounts of structured and unstructured data available. This requires the ability to know what exactly to look for in the data, and how it can be used to gain a competitive advantage. Commercial awareness involves the ability to anticipate financial trends and future business developments across the globe. Knowing where market changes are going to occur is vital for either expanding or protecting a particular area of the bank's portfolio. It is, in the corporate world, necessary to understand how businesses operate and what drives them. If you are working with a client in a particular industry, for instance, then you need to know everything about the climate, risks, and potential change factors of that industry. Having background knowledge of different industries, and keeping up with the newest trends, developments, and changes in the banking world, and beyond, will be integral to your success. A keen eye for detail is another requisite for banking, whether it's noticing particular trends or activities that nobody else has, producing complex financial reports for senior management, or the ability to spot anomalies. Determination to succeed in an extremely competitive environment, demonstrated through a strong work ethic, and resilience to stay the course, while reacting positively to everything around you, will allow you to thrive and grow in confidence. Technical skills in a digital age where the large majority of the decisions are based on data analysis will become increasingly more important. This involves the ability to find information, access and process data, and to communicate with other stakeholders. This requires bankers to be tech-savvy. Soft skills are also important. Communication is a key skill, whether it's explaining complex financial concepts or procedures to non-financial clients, writing and compiling in-depth reports, or learning to communicate in a professional manner at management level. Finding the right business model to guide the banking industry into the future, and to create sustainable ways of generating profits, is obviously of great strategic significance. One key area involves fee and commission-based activities in order to create more diversified income sources, while reducing the reliance on net interest income. Finding the right talent is equally important. The banks of the future will require people with the right skills to fit this future vision, where a substantial portion of a bank's income is derived from activities that can generate fee income. In this presentation, we traced the concept of interest back through the ages. There were times when the charging of interest was allowed and at times it was not allowed. For a long time, interest income was the main source of income for banks. An assessment of the combined balance sheet of the South African banks revealed the importance of both interest and non-interest income. We established that banks currently earn about 60% of their income from interest on loans and 40% was generated through non-interest or fee income. We also considered the weighted average cost of debt and equity funding in order to determine the bank's net interest income and net interest margin. The importance of the repo rate, as a benchmark for all interest rates in the economy, was highlighted, and how the repo rate is used by the Reserve Bank, as part of its monetary policy, to achieve 6 main economic objectives within the economy. We distinguished between a bank's banking book, dealing with loans and advances, and its trading book, dealing with investment activities. 3 main risks faced by the banking industry, namely credit risk, market risk, and interest rate risk, were briefly discussed. We established that there is an inverse relationship between interest rates and bond prices, and we also distinguished between interest rates and yields. By being able to interpret the term structure of interest rates, we are now in a position to express an opinion on future interest rate movements. With interest rates playing such a crucial role in the business of a bank, both in its banking book and its trading book, we set about to answer the question as to how saving and investment decisions are made. We considered the classical theory, the loanable funds theory, Keynes' liquidity preference as well as Fisher's MV equals PY equation. Fisher's equation directly links the money side of the economy, and the real economy, through the operation of interest rates as a transmission mechanism. The bulk of this presentation dealt with interest rates and a bank's interest income. The conclusion, however, highlighted the importance of non-interest or fee-based income. The statement was made that anybody can lend money and charge interest, but that unique skills are required when acting as a trusted advisor in order to generate fee income. Banks are facing challenges to the traditional banking model where deposits are converted into loans. Bankers who improve their skill sets with the aim to generate more fee income will remain relevant and important to the success of the banks of the future.